think that's everyone seems to be joined in now, so we'll just get started, and I'm sure a few people will join us partway through. Welcome to the second online event that we've run at the EAA. This one is Employee-Owned Practice, the Transition and Reality of Changing to Employee Ownership. We decided to run this topic off the back of quite a lot of growing interest and popularity in the kind of business model, but perhaps a kind of general lack of understanding about logistics of making the change and then running the practice in that way moving forward. So we've set up the event with 5 short talks. We're going to have a small comfort break in the middle, and we're going to have questions as well, which you're welcome to submit via the chat function. We'll either read those out ourselves, or we'll have you guys turn your video and microphone back on and ask them yourself, depending on sort of how many we get and what kind of questions we're getting. But feel free to pop them in the chat function as we go along, and then we can kind of get a sense of what people are wanting to know. I see everyone's got their cameras off already. You should just see me and our 5 speakers on the screen. If you see more people than that, you can go to your video settings and make sure that you've got hide non-video participants checked. That means that once we get started and we share the presentations on screen, the rest of us up here will turn our videos off, and you should just see the speaker and the presentation side by side, which obviously just means that you can kind of, read it a little bit easier where there's text and so on. So if you just keep your cameras and mics off for now, we'll maybe bring them back in later for question time. So we're planning to run for about an hour and a half. Our first 3 speakers are going to talk for 15 minutes each, and then we're going to have a short break. First of all, we're going to have Glenn Dott speaking. Glenn's going to give us a sort of an introduction, overarching view of employee ownership and how it works, sort of setting the scene a little bit for the rest of the speakers. Glenn's employee ownership specialist advisor at the Cooperative Development Scotland. He's been involved in employee ownership for over 10 years across Scotland and worked with over 400 companies, varying in size from 5 to 500 employees. After Glenn, we're going to have Stephen Chan and Val King, and I'll tell you a little bit more about them when it's their turn to talk. So I'll just pass over to Glenn, and if all the rest of the speakers can just pop their videos off for now, I'll share my screen where I've got the presentation for Glenn.
Thanks very much. So as you can see, I'm badged as from CDS / Scottish Enterprise. And if we can move on to the first slide, we're a specialist unit within Scottish Enterprise, and we have as our main function to promote and provide specialist advice on succession and employee ownership in particular. And as the picture indicates there, we're a catalyst. So most of the deals, the employee ownership deals that happen in Scotland, we've been involved in one form or another. And we do this by working with both public and private sector advisors, including those in the Business Gateway, Scottish Enterprise account managers, Highlands and Islands Enterprise, lawyers, accountants, and other employee engagement advisors. If we could move on. So the problem that we're trying to solve is that there are 16,000 owners in Scotland who want to exit in the next 5 years, and not too many of those have very clear plans. And from a government perspective, Scotland, as does the UK, suffers from productivity and innovation issues, and we are probably, I believe it's in the 3rd sector of the OECD rankings in both of those. And we're wanting also to grow our economy and also sustain the businesses that we do have here, particularly in these trying times. And particularly the Scottish Government is interested in retaining jobs and businesses within Scotland and also within their local areas. So certainly people in Highlands and Islands Enterprise are interested in retaining those jobs and businesses in often very rural areas, but that goes for all businesses throughout Scotland. In terms of succession planning, there isn't a formal methodology for business owners to be looking at all succession options. In the main, accountants and legal advisors would concentrate on trade sales, perhaps listings, and trade sales would make up by far the majority of business transfers within Scotland. And many of those businesses are sold out with Scotland, leading to a potential relocation of the business. And certainly in terms of the conundrum of poor productivity and innovation within Scottish businesses, obviously the government here wants to improve those dramatically. And lastly, in Scotland's economic strategy, there is an attempt to reduce the inequality between the haves and the have-nots. And certainly with an employee ownership business model where all employees become owners, you would see that as being reducing this level of inequality. Moving on. Our definition of employee ownership has two main strands, and employee ownership, we would expect to see significant ownership by employees, typically via trust ownership and also via individual share ownership. If we could move the slide on. Thank you. And the second strand of employee ownership is enhanced employee influence. And Stephen will go into more detail, but in effect, the enhanced employee influence comes about via three main methods. Employee trustees, elected employee directors, and in larger firms, an employee council. But typically that would only be relevant in a business where there's more than 50 employees. So moving on again, just to give you an overview of the number of employee-owned businesses in Scotland. There are over 120, probably closer to 130 now. These make up over 900 million worth of turnover, and there's more than 7,300 employees employed in the sector. We, CDS, have helped catalyze 70 employee ownership deals over the past years, and there have been at least 8 post-lockdown deals. So certainly the current situation hasn't hindered any transfers to employee ownership. And in fact, many owners who may have been undecided in the future may now well be making a firm decision about going forward. And certainly employee ownership is something that you can start tomorrow if you so wish, whereas a trade sale, you would need to have willing buyers out there. And certainly from the figures that I've seen, both here and overseas, deal numbers have been reduced. Perhaps Stephen can say something about that later on. There are a couple of new announcements that we're expecting in the near future about new transitions going forward. And the big, hairy, audacious goal is to achieve 500 employee-owned businesses by the year 2030. This is in conjunction with the help of Scotland for employee ownership. A bit more about that later. If we can move on. The next slide just gives you some of the examples of employee-owned businesses which are operating in Scotland. Some of them operate countrywide. Obviously, John Lewis is the largest at something in excess of 80,000 partners. Probably better known ones, Aquascot up north, and you might recognize some more of those numbers. Just to go on to some individual examples, it's not just the architectural sector that's interested in employee ownership. The model is applicable to many other businesses. If you could move on, thank you. Aquascot, they were a mere 3.6 million turnover in 2017. and they're around about 50 million turnover right now. So they're based in Orness, north of Inverness. And if you eat trout and salmon products, and I'm sure most architects do, if you buy them from Waitrose, you'll be eating an Aquascot product. The next slide. Gerber camper vans, east of Edinburgh, they're based, and Gerber camper vans became employee-owned in 2018, 1.6 million turnover, 20 staff, and they have a very full order book based near North Berwick. And founder Simon Poole is just in his early 50s and will exit the business within 5 years to go and pursue other objectives. Moving on again, many of you, particularly those from Glasgow, would have gone over to Arran and stayed in Auchrani. So in 2018, they became employee-owned, 8 million turnover, 100 full-time staff. As you can imagine, they have particular issues at the moment with the lockdown. But the sale to an employee ownership trust met the founders' objectives. And they certainly didn't want one of the multinationals to be buying the business. Moving on again, if you're doing hill walking, you must surely be using Harvey's maps. These are all waterproof. And this is a little business based in Doon, just outside of Stirling, very much favoured by hill walkers because of their accuracy. They're relatively small, a 650k turnover with 9 employees. And founders Sue and Robin, again, didn't want the business to be swallowed up by Ordnance Survey, or they wanted the business to be retained in the local area, and that's staying in Doon. Next slide. So how can we help clients? We promote succession and the employee ownership model in a number of different ways. We have client-focused events. We have 4 webinars scheduled for 2020. In the next week or 2, we'll start advertising those. We also have a series of advisor-focused events for advisors, 4 of those in 2020. Again, they will be announced very shortly. We have a load of case studies, reading materials, and podcasts. If you go and look at our website, which I'll bring up shortly. For clients, if they are interested in employee ownership and want some support, we can provide up to 3 days free service. The first day is an ownership succession review, and the second 2 days is an employee ownership feasibility study. And that feasibility study is just a decision-making document for owners to decide whether this model is for them. And lastly, just to note that we work with all sorts of clients, primarily public and private sector, the private sector advisors, lawyers, accountants, and many others. Moving on, if you are interested in our podcast series, there is the address there. And if you type into your podcast supplier, the Employee Ownership Podcast, you'll surely find us. Just to say something on the next slide about Scotland for Employee Ownership. This is an industry leadership group committed to building a stronger, larger, more confident employee ownership community in Scotland. They are going to help us meet this big, hairy, audacious goal. And that's me, folks. So I'm sure we will be circulating the slides, and I'll be happy to answer any questions now or later. Thank you.
Thank you very much. Next up, we've got Stephen Chan. He's going to give us a sort of legal perspective on all this, particularly some of the tax benefits and some sort of do's and don'ts. Stephen is a partner in the Harper McLeod corporate team. He's been recommended by Legal 500, and he has a huge range of experience in corporate and corporate finance work. If you're interested in a wee holiday read, he's also written a book called A Practical Guide to Partnership Law in Scotland. So I'll just share my screen and start your presentation, Stephen.
Hello, Fiona, can you see me? My picture's disappeared.
I can see you, Stephen.
All right, okay,
Yeah,
fine. All right, okay. For some reason, my picture's disappeared, but we'll start then. Thank you, Fiona, for the introduction and the opportunity to speak today. Since Fiona's mentioned my book, I don't know if you can see it, because I can't see the picture. Here is the copy of the book. And I always do a shameless plug, available at all good bookshops. Actually, it's only available at university bookshops for the princely sum of £75. So now that my plug is over with, you can probably just go and speak about employee ownership. I should prefix the my talk, just quickly say that I'm being asked to touch upon tax, but I'm not an accountant. I should always seek specialist tax advice on this, but I will go through a couple of the tax points. So today, what I'm going to be talking about is just the legal structures available for this. It's basically three different types of structures generally available for the employee ownership. They are essentially the direct model, the indirect model, and then you get a hybrid model. The hybrid model is essentially just a combination of the direct and the indirect model. And we won't go through that today. We'll just only be focusing on direct and an indirect model. John, can I just check? The slide seems to jump straight to the direct model. Can you just go back to the slide that starts indirect model, please? Yes, that's great. Oh, just forward to where it says, yeah, that's great, just there. Thank you very much for that. So the indirect model, how does that work? Well, essentially what you will have here is that you will have a discretionary employee trust set up. And that's why it's also commonly known as a trust model. And this is also the model used by John Lewis. In this scenario, what you would have is you would have a trust set up. The trust will be the entity that acquires the shares of the company. It will enter into a share purchase agreement with the owners of the company. And what will also happen is that the trust, in all likelihood, will not have any monies to pay the shareholders of the company. And so what it would normally be structured is that the consideration for the shares will be left outstanding by way of a loan. That will be paid over a number of years. And we've done deals of this nature where it could be even as long as 10 years for the payment period. And then, so the payment period was 10 years. What you would find is that the company would generate hopefully profits in this period, and then the profits of the company would then be passed along to the trust, and the trust would use that to pay off the shareholders. So in this indirect model, or would be the same as the direct model for employee ownership, the shareholders will be looking at quite a long period of time before they realise the full value of the shares. In this model also, the employees do not own any shares directly in the company. Instead, the shares are owned by the trust, and the employees instead will be the beneficiaries of the trust, and hence why it's also commonly known as the indirect model, because it's indirect ownership of the shares in the company. And in terms of how it's run and the documentation, what you will have is you will have the trust. The trust will be run by the trustees. There will be a trust deed put in place to specify how the trust is run by the trustees, and also the appointment of the trustees. The trustees can be individuals or corporate trustees. When we're talking about individuals, they can be employees of the company, and the corporate trustees will be, will be a professional person or company who will act as the trustee. And you may even have a mixture of the two, where you have individual trustees or employees, and also corporate trustees who really are professionals in this sector. The reason for that is that trustees will owe fiduciary duties to the trust. And so you may want, especially in the earlier years, having a corporate trustee in place who will help to advise the individual trustees as to their duties and how to run the trust. You will also, in this structure, the company will continue to be run by the directors, and the directors will be run for the company in the best interest of the company. There will be articles of association adopted for the company. These essentially are the constitutional rules of the company, and they would set out a variety of things, such as, for instance, how directors are appointed, number of directors on the board. You may find in these scenarios whereby some of the trustees and directors are perhaps the same people, but they do wear different hats and roles. The trustees are really there to run the trust, and they're for the benefit and the interest of the beneficiaries. The company directors are there to run the company for the benefit and the best interest of the company. So they do have different slightly hats that they wear, and it's just something to be mindful of that if they happen to be the same individuals. And it's also the fact that if you are a company director and you are, for instance, appointed to the company more as an employee director, the director will still have a duty of confidentiality. So anything that they say or do in the board will still be confidential. So then they can't exactly then next minute wearing hats employee go and say that to the other employees, unless it was pre-approved by the board of directors. As Glenn has also mentioned, just kind of touching upon this, there may also be an employee council as well, depending on the size of the company and the number of employees in the company. An employee council really there is just an advisory board to help participation by the employees as a whole in helping the trustees when they take any decisions for the trust. We can now just go to the next slide. So what are the advantages of having employee ownership, and in particular the indirect model? Well, for a start, the main benefit of having employee ownership is it produces stable long-term structure and allows succession, particularly where there is no buyer for the business. So that's quite important. If I was to be honest here, then not for architectural businesses, but certainly, for instance, manufacturing or even consultancy businesses, what we've seen is if you have a trade buyer for the business, the owner is likely to sell to a trade buyer for no other reason. They will get a premium on the price. For businesses like architectural businesses, where there's no ready-made market for trade buyers, and the owners want to retire eventually from the business, then they would look at the employee ownership, because it in a way allows succession and passes on the business to its employees. And second bullet point is talking about the market value for the shares of the seller, so that well, I was to be honest, you will possibly not get as much for employee ownership as you would get for a trade sale. You would get the market value, and how that works is that there will be a valuation carried out by professional valuers, as to the market value of those shares. So then the sellers can be comforted that they will get what is considered a reasonable amount for their shares. And just maybe we're touching upon the sale of the shares. As I said, it's more than likely that the sellers will have to wait a period of time before they can get their full value for that, because it will be paid out over a number of years from the profits of the company. It may be possible for the trust to borrow monies from specialist lenders. Now, there's a very small number of these that will potentially lend to businesses for maybe not the full amount of for the loans, but maybe a partial amount. But the only other thing I would add to that is that when I've spoken to specialist lenders in the past, there's possibly less of an appetite to lend to architectural businesses, and that their preference is also always to lend to businesses that have a bit more bricks and mortars and can offer better security. One of the main benefits, though, even though the seller will have to wait a period of time to get the full value for the shares, one of the great benefits for a seller, and this is me touch upon tax now, is that the seller may be able to pay no capital gains tax whatsoever, subject to it meeting various qualifying conditions. And that's quite a huge bonus for the sellers. Ordinarily, if sellers would sell the shares in a company, then subject to them meeting certain criteria, they would only pay 10%. And that's when they get what is called as entrepreneur's relief. If they don't get entrepreneur's relief, they'll pay 20% capital gains tax if they're a higher rate taxpayer. So in this scenario of indirect model selling to employee trust, they can potentially pay zero tax on the gains. But that's again subject to qualified conditions, which I'll go through the next slide. The other point to note is the benefit for the employees is that if we use this indirect model, all the employees can receive a tax-free bonus of £3,600 every year. And the final benefit advantage of the indirect model is that even though the employees are not direct owners of the company, they will still be owners ultimately through this indirect model, being beneficiaries of the trust. And so they may feel a closer connection to the business, and there may be less issues with employees leaving. I'm going to go to the next slide. So what are the disadvantages for the indirect model? Well, the main one is that if you go through this indirect model and the business does fabulously well, and the business is worth quite a lot of money, it's not the case that the trust will obviously own the shares, that they sell the shares, and the employees will benefit from the capital gain on the shares. Because employees are not the shareholders, they're merely the beneficiaries. So they don't benefit from a sale. And indeed, that's one of the reasons, one of the benefits of the indirect model is that once you moved into indirect model, it doesn't really foresee a future sale of the business, that it will essentially just remain in the employee ownership trust model for the long term. The other disadvantage is that, because we're having this indirect model, ownership may not feel as real for the employees. They're not getting an actual bit of paper like a share certificate with the name on it saying they own these number of shares in the company. So just briefly touch upon the key qualifying conditions, which is the next slide. That's great, thanks. So I say you need these key qualifying conditions to be met in order to benefit from the tax advantages. And the main tax advantage said is for the seller that he essentially pays 0% capital gains tax. Again, these are primarily tax rules advised by accountants, but I'll just briefly touch upon them. So the first one is the trading requirement. So the company's got to be trading, and more often than not, that will be complied with. The next one is there's going to be a control of interest taken over by the trust. So the trust must acquire 51% of the shareholding or more. The other one is the all employee benefit and equality requirement rule. What this means is that all the employees must be treated on the same terms, and that so the trust cannot prioritise benefits to certain employees over others. There may, however, be a little bit of leeway in terms of benefits depending on that employee's salary and length of service. But that you've got to take a lot of advice on that to ensure that if you are paying benefits to different employees based on the salary or length of service, that you don't do so in a way that fails as qualified condition. And I remember, and this is something that's very hard, I think, for the senior management to understand. I had another scenario of a client where it was the directors and they weren't the owners, so they weren't selling. But I told them that once you move in employee ownership, your benefits as a beneficiary, not as an employee, but as a beneficiary, really will have to be the same as anyone else, based on the equality principle that all employees are treated the same. And that you may get more salary, but you can't get more benefits arising from this. And I finally, just touching upon it, is a limited participation rule. And these are rules relating to the ownership of the shares, how long they've been held for, and the number of sellers who still own shares after the sale. Again, it's a very complicated rule, but in brief, that if in the 12 months up to the sale of the shares, you own 5% or more, you take these number of people post-sale, and you've got to make sure that these number of people who have previous 5% more do not exceed 40% post-sale of the shares. So now we'll just briefly go to the direct model, if we can. Thank you. So the direct model is, as it suggests, it is where the employees will directly own shares in the company. So here you'll see that instead of the trust buying the shares, it'll be the shareholders who are the employees will buy the shares. They will be them who owe the payment of the shares to the former owners of the company. And as before, their company will be run by the directors. In terms of documentation here, because there is no trust, there is of course no trust deed, but there will be a shareholders agreement signed by all the shareholders. And you may also have an employee council here, depending on the size of the company. And to the next slide of the advantages and disadvantages of this is, again, with the indirect model for employee ownership, it will produce a stable long-term structure, allow succession where there's no buyer for the business. And again, with indirect model, it will allow seller to sell for full market value. But a difference between the indirect model here is, I said, employees will hold the shares directly. They will be a shareholder of the company. They will have a nice share certificate that says that they hold so many shares in the company. So then if the company makes any profits, and this is after profits are needed to pay off the former owners, any remaining amounts, they can decide to pay as dividends to the employees. So employees will benefit directly from the, with the well-being of the company. Admittedly, I'll have to pay tax on these dividends. But it's also a crucial difference between indirect model here is if they decide, if the company was then to be sold at a later date, because the employees here are direct owners of the company, they are shareholders, they will benefit from the sale of the company. And there's even the possibility, depending on whether or not satisfy the rules, they may even qualify for entrepreneur's relief, which means they will only pay 10% on the gain. Final advantage is that it may possibly be cheaper to set up as the you don't have the trust element here. You don't need corporate trustees on board. Again, finally, just to touch upon the disadvantaged direct model, as I said, the employees hold shares directly. For the astute viewers here, that's the same advantage above that employees hold shares directly. And the reason for this is as these employees will be shareholders, they will have the benefit of company legislation. So give an example is that under company law, shareholders holding over 50% of the voting rights can remove a director. So the employees as shareholders will have that right if enough of them clump together. They will also hold those shares directly, which means that even if they cease being an employee, they will still hold shares. And that differs from an indirect model, whereby that if in an indirect model, they'll only be beneficiaries under the trust. If they cease being an employee, they cease being a beneficiary. Nothing needs to be done to take the shares off them, because the shares are owned by the trust. Here, where the employees are the shareholders who hold the shares directly, we do need to do something to take the shares off them. And normally there will be a procedure in the shareholders agreement to deal with that. And while there's a procedure to deal with that, it can't be underestimated that there will be a hassle factor to this. I mean, we dealt with a manufacturing business that went through this direct model, and there was provisions in the shareholders agreement and articles talking about taking back the shares of employees had left. But what the management had underestimated was that there was still quite a few people going, and there was quite a process to take back shares. And by way of example, another business we deal with here is that when employees leave, there is a process like twice a year they'll take back the shares. So instead of, whenever one employee leaves, you go through the process, take back the shares, and another one leaves in 2 weeks time, another process. Essentially, they just roll them up and they do the process every 6 months. So then it's less of an administrative burden. Okay, so that concludes my talk, and thanks for the opportunity again to speak today, and welcome any questions later.
Thank you very much. Next up, we've got Val King. Val is a former owner and managing director of a company most of you will be familiar with, the Rooflight Company. She and her husband recently sold a majority shareholding of the business to their employees. She's now a trustee of the newly formed Employee Ownership Trust. She's recently set up BFG, Business as a Force for Good Associates, and also sits on the Employee Ownership Association Membership Council. She's going to give us a bit of an overview of her own experience and touch on some of the benefits for employers and exit strategies based on her own experience. So I'll just pass you over to Val. Thank you.
Hi there. Can everyone see the screen, the slides now?
Yes, I can see you clearly, Val. Thank you.
Excellent. Thank you. Good evening, everyone. So I'm going to spend the next 15 minutes sharing my experiences of the transition from private ownership to employee ownership. And as a member of the Employee Ownership Membership Council, I'm going to share some data on a recent study on the employee ownership sector. So last March, Pete and I, my husband and I, sold a majority shareholding to our 70 employees. And we did that via an employee ownership trust. So the hybrid indirect model, as Stephen was mentioning. And I handed over the role of managing director to our former operations director, Steve, 1 week before lockdown. So you can imagine the baptism of fire that he's been through in the last few months. But first, a bit of background on Rooflight Company, I should say. So for those of you who are not familiar, it was set up by Pete, my husband, who's an architect and a member of RIES. He was actually practicing in North London at the Hampstead Garden suburb and couldn't find a product for his clients. And they wanted to extend into their attic, and all he could find was something that was a cast iron roof light based on the Victorian cast iron model. And so he decided to design a product that looked like the cast iron model, and the conservation roof light was born. And since then, we've developed lots of different other products and bespoke projects in the historic and the contemporary sector. So as I was saying, when we started this process, it was some time back, and I'm going to run through that. But one thing I wanted to share with you was that Pete, in fact, decided that his passion for architecture, it took over, and he realised that he no longer wanted to run the business. So he stepped back and I took over as MD in the mid-90s, and I came from the corporate sector. So like every exiting business owner, I'm sure some of you are in that position now, we had to look at the options for exiting. And one of them was passing on to their family, but unfortunately neither our daughter or son was interested. So that was out of the question. And then the second option was a management buyout. So firstly, none of our managers or directors approached us. So that was one reason for not pursuing this. But the second one was because I'd heard over the years of a large number of management buyouts that didn't really end well. It was, this is largely due to the funding required, where there was a lot of pressure put on the executive team who were left. And so the exiting business owner got their money, but the end result was that the business either failed or was passed on very quickly to a new owner. So we decided that that wasn't an option. For us, a trade sale was an option, and in fact, we were approached by a competitor, a kind of Me Too Velux company, who you might be familiar with. And so strategically for them, it made sense. But their production was in Poland, and they seemed like decent guys. But the problem was, we knew that our legacy of values-led culture and innovation would be lost, and so too the jobs of most of our employees. So we decided that that wasn't an option. So when we're looking at this process of elimination, we realised just how important our legacy was and the livelihood of our employees. So it really took us this process to think, well, what is important to us? And that's so important when you're thinking about such a big decision. So when James, our financial director, started talking about employee ownership, we decided to really investigate that. And in the end, to be honest, sitting here now, a year on from selling, or a year and a bit on from selling, I would say that it's really the only option that I think protects employees and provides that legacy. So once we decided that we were going on the employee ownership journey, I decided to use a project management model that we use for all of our projects that has 4 key aspects: the preparation, developing the optimum solution, implementation, and integration. And we started off by going to the Employee Ownership Association conference, which unfortunately won't be available to you this year because of COVID-19, but there will be some seminars or webinars available towards the end of the year. And one of the big lessons I learned there was that it can land badly. Sometimes if you don't do this well, then it can create a lot of confusion. So I decided to do everything I could to make sure that that the transition went well. And so one of the first things we needed to do was to appoint a legal advisor, and Stephen is obviously one, and Glenn would be able to help you with this as well. So we decided on a legal advisor called Robert Postlethwaite, and then we used Jeremy Gadd Associates, and they have a lot of experience in employee ownership with a view to the cultural and the organisational part of the transition. So what I'm going to do is to take you through this journey as briefly as possible. And so in the preparation phase, we also prepared a project contract. And that involves things like the goal, the vision, what do you actually want to see? So it's trying to think forward and thinking starting with the end in mind, as Stephen Covey says. But you know that it's not going to be the same as you imagine. That's one thing for sure. But it's trying to think ahead of what you really want out of this, what you really, really want. So we developed the project the contract, and then the next phase was really to decide what structure it was. And so we decided on the hybrid structure, which was to sell part of our shares, a minimum of 51%, to the trust. And then to also think about the Board of Trustees, what we really wanted from them. Now, unfortunately, in 2017, so this is why it took so long, we actually put the project on hold because there was a lot of uncertainty after the Brexit referendum. And so we decided to concentrate on the business. And almost a year later, we started the transition again. Fortunately, the business did turn around, and that was a good thing. So working on the trust deed, which was mentioned by Stephen, this is a really important document. And in our case, it was 29 pages. But it's important to think about the detail there, because what you're trying to do is to legislate for eventualities in the future. Our trust deed is 125 years, so that takes us to 2144, which is a lot of eventualities. And so you're trying to think ahead. But I'm heartened by John Speeden Lewis, who started the John Lewis Partnership. Back in 1929, he went through. He set out the guiding principles, and I really do love the first principle of the partnership, and what he actually stated was that the partnership's ultimate purpose, this is John Lewis Partnership, is the happiness of all of its members through their worthwhile and satisfying employment in a successful business. So clearly he was way ahead of his time in terms of enlightened approach to employees. And although John Lewis are going through a huge amount of turmoil, unlike a lot of people in the retail space, they are much more likely to survive because of the fact that they have these guiding principles and the trust deed. So we decided our legacy, we had 3 guiding principles, and that was values-led culture, which I'd worked quite hard to inculcate in the business, as well as innovation, because we had innovated a lot of new products and processes, and then sustainability, long-term sustainability. So this is both in terms of the profitability of the business and the environment. Both Pete and I are members of Extinction Rebellion, so the environment's really important to us. So these guiding principles are embedded in the trust deed, and it's important that we, the Board of Trustees, because I'm now on the Board of Trustees, hold the executive team or the Board of Directors to account on these guiding principles. And it's quite a tricky thing to actually balance the three areas. So it's something that they are very mindful of. Now, in order to set up the new trust, you have to set up you have to have a new company. In our case, Reflect Trustees Limited, and so this is the legal entity through which the trust operates. And you also need to commission an independent valuation, as Stephen was mentioning. And in fact, I have to say, in our case, I was actually quite pleased with the valuation. I don't have any complaints about how that went. And so it's important that it's done professionally, and so that HMRC can't challenge it. And we also had to decide on the percentage of shares. And so we were having a conversation of this, and you have to have 51% shares. So that's a minimum, and we decided that 60% would not overburden the business in terms of the debt, and so we ended up selling our 60%, and then we retain the 40%. Now, I'll be absolutely honest, I am still not sure what we're going to do with that. Some businesses, and there's a practice, Alfred Holman and Morris, where I met Peter Morris, they sold 60% to the trust, and they are going to gift 40% after they receive their payment. Now, we decided an 8-year payback. The average is somewhere between 5 and 8 years. So we'll wait and see, but we still haven't quite decided what we're going to do about that. So in addition to the trust deed, yes, just some reminder about the CGT exemption. In addition to the trust deed, a board of trustees has to be formed. And we decided that we were going to have 3 independent trustees. We decided that they were not necessarily corporate trustees, but one of them is very experienced in employee ownership, and that was Jeremy. We also wanted somebody who was very experienced in business as well, and he became the chair of the trustees. And that's an important aspect to decide who the chair is. The chair role was actually, we probably underestimated the importance of the chair role. And then we brought in 2 co-owner trustees, and they are voted for by their colleagues, and then a vendor trustee who was initially Pete and is now me. So I felt it was important not to have people on the executive team on the board of trustees, but for a smaller business or practice that might be difficult. But I really do believe it is the board of trustees to hold the board of directors to account in terms of the performance of the business, how the people are feeling. So for example, I'll be having a board of trustees meeting on the 20th, and so there'll be a survey of employees, and I'll be looking carefully at that. And yesterday I went into the business to try and take the temperature and see how people were feeling. And on the whole, considering COVID-19 has had a big impact, things are going well, and the people can see a future for the company, and that's really important to them. Obviously, it's important to all employees, but particularly when you're employee owned. So by November 18, we engaged the leadership team. I hadn't actually told my colleagues, which was quite difficult really, to be honest, but I decided that they needed to concentrate on the business, and I thought the transition might be a diversion. And then we finalized the communication plan. So our board of directors is called the leadership team, just to explain that. And I took them to the employee ownership conference, and they were so inspired by the great stories that Glenn was talking about, some of the stories you hear about. So the people are so engaged and passionate about the employee ownership concept. So you do get carried away with some of their enthusiasm. So onto the implementation phase, we engaged managers, and then we made company-wide announcement. You have to get, we prepared a bunch of FAQs just to try and anticipate some of the questions that they were going to ask, because obviously the first thing they're going to ask is, well, what about me? What about my job? And so we decided to prepare these in advance, and that was actually quite helpful, because uncertainty is the death of good communication, and so to try and anticipate things is important. So on the day of the deal, we had over 20 documents to sign, but it was all done and dusted by lunchtime. And then we celebrated with our colleagues and had cake and bubbly. It was all very positive. And then 2 months later, we had our first Board of Trustee meeting. And I have to be honest and say it was tougher than I thought. I really had to kind of decouple myself from the fact that I was an owner. And I think it took me a couple of months, maybe even longer, to really get my head around it, and also from an emotional point of view. So we prepared well for the first trustee meeting, but I was challenged in quite a lot of stuff. And I was, I don't think I was quite prepared for that. But by the second or third meeting, I kind of got used to the idea of actually reporting to a board of trustees. And now I'm on the other side of the table, so I can sympathise and empathise with Steve, who's our managing director. So we're now into the integration phase, and we decided not to rush the election of the co-owner trustees. They came on board and were elected by their colleagues. I was really pleased to see a very, very good turnout, 12 candidates from the non-manager side, and then 4 for the manager side, manager trustee. And then similarly, we didn't want to rush into the elected body or the council, which we call the voice group. And they were elected in January. And so there are 5 of them based on geographical areas. And so that has gone really well. And the key thing is to keep people engaged and enthusiastic about the concept of employee ownership. And then the latest step in the EO journey is appointment of my replacement. That was Steve. And in many employee-owned businesses, people stay on for longer. They stay on for quite a lot longer, but I decided I wanted to move on to other things. So actually, I only stayed in post as MD for a year. And in terms of succession planning, I knew that Steve, our ops director, was a strong candidate, but I had decided not to assume that, and not to let him assume that he was the heir apparent, so to speak. So we decided to open up the recruitment to external candidates, and we put out a job spec, which was really about the company. Do you believe in business as a force for good? And we had 318 applicants, which had to be whittled down. And eventually we had a shortlist of 3, and Steve actually got the job, and he has been doing a really good job. And considering COVID-19, it's really important to have somebody who knows what they're doing, and thankfully he does. So what's changed since becoming employee owned? Well, I ask that question of co-owners quite a lot, and I get a common response is a feeling of certainty and security for the future for themselves. And another is a feeling of having a greater say in the business. And co-owners do have a greater say. For example, we asked them what they wanted from their new managing director, and the voice group were involved in the selection process, and the co-owner trustees were actually on the panel. So they do have a say. And another change is even greater open communication. So you have to be transparent really to make it really work. And so we used to share a lot of financials, including profit, but now we share things like the bank balance and cash flow forecast. So when the news is not so good, they're actually aware. In my view, it's like treating them like grown-ups. You know, they know what's going on in the business from the financial point of view, as well as other aspects and strategy, for example. So I hope you understand a bit more of what's involved in transitioning to employee ownership. And as a member of the Membership Council, I just want to share some data on a recent study. It was compiled by Leeds University and RM2, who are advisors, published by the Employee Ownership Association. So combined sales of the top 50 employee-owned businesses were up 4.3%. So this is basically January of 2020, pre-COVID-19. And this compares with 1.2% in the UK economy. And then there's an increase of 1% in employees. The median increase in operating profit was up 5%, and 66% of companies in the EO sector have no debt. Now, you can imagine how important that has been in the present circumstances. So the final one is productivity. It's gone up by 6.9% compared to -1 in the UK economy as a whole. So you can see there that there is a better performance overall of employee-owned businesses, because employees really do feel part of it and they're much more motivated. And on that subject, you can see some of our other employee-owned businesses. This is an older study, but this one showed that 80% of employees are happy to recommend the organisation as a place to work, and 80% of employee owners experience a sense of achievement from their jobs. And this is very consistent with our surveys, in fact. And I think, in fact, we got about 90% of people who were happy to recommend. So that really shows that motivated employees are a direct result of employee ownership. And so of the 470 employee-owned businesses, 50% are in the professional sector, and a large number of them are architects. And I believe that it's the way that you work together in a collaborative way that I think is so well aligned to employee ownership. And so in the architect sector, it's no surprise that more and more people from architectural practices are transitioning to employee ownership. And in my view, it is really the only ownership model that you can pass on a legacy as well as guarantee the jobs of the employees. So thanks very much for that, and I'll stop sharing now.
Thank you. That was so interesting. You really rattled through that and landed perfectly on time. So I think we'll take just a 5-minute comfort break, let everyone kind of stretch their legs and whatnot, and we'll come back. We'll maybe take a couple of questions if there's anything that's kind of that's come up so far that we think is sort of be good to catch before we move on. And then we're going to hear from 2 architects who are going to tell us about their own experience of transitioning to employee ownership business. So I'll just mute myself and turn off the video, and we'll start again in 5 minutes, which will be about 7 minutes past 7. You're on mute, Chris, still, just so you know. You might be intending to be.
No, I wasn't. All right, there's some serious presentations there, by the way.
I know.
Mine is not like that.
I've got all.
I'm afraid I've probably got the...
Let's just get started again. I know I've got a couple of questions, but I'm conscious that they might be answered by the next couple of speakers, so I'll just hang fire on those. Oh, Chris has left.
Hey, Chris.
Come back. Okay, so next up we're going to have Chris Stewart from Collective Architecture. He's going to give us a bit of an insight into his own experience, and I don't know, maybe has some lessons for us to share. And then after that, we're going to have Hannah McFarlane from Anderson, Bell and Christie, who have more recently turned into an employee ownership business. So, Chris, I'll just let you share your screen and...
Is that working?
Yeah, that is, yeah.
Is that working now, Fiona?
Yep, perfect.
Okay. Right, hello everybody. I probably, things are going to get a bit messy now, partly intentionally, because I perhaps prepared the wrong kind of presentation for this talk. It's quite serious. We know our stuff. We know about deeds of trust. We know about articles of association. We know this stuff, but I thought this was going to be a bit of a personal journey. So bear with me, and I will try and explain some of the things that we got up to, and perhaps some of the things that we didn't get right, and some of the things that we did get right through this presentation. So in many respects, it goes way back to, well, it's Tony Blair now, isn't it? So it's way back in 1997, when we first kind of got started. We set out specifically to pursue the themes of sustainability and participation in architecture. That's what it was all about. And these are just some examples of the way we go about our craft. It's so important to us. It's so fundamental to collective architecture. It was always been at the bedrock of what we do. Sit right back to the 1st of May 1997. That was the whole raison d'etre for us being. Now, I mean, I like this slide because this is actually our very first client. So we go out into the community. At this time, we're not an employee-owned company. But at that time, we went out into the community. We worked with people. It was all about being democratic, and we were convinced, and we still are convinced, and that's what I wanted to talk about, is that there's an architecture in participation. There's an architecture in working with communities. And I think there's an architecture through employee ownership. I think it actually physically affects what your buildings look like and how they function. I think it's as crucial as that. It's more than a business. It's actually a kind of principle, a lifelong principle. It's a philosophy. So that is the point that I was wanting to talk about. I mean, and that was the MAD, working with mothers against drugs. We marched through the streets of Cranhill with them. And in the end, we found structures in their community that we could light up and give them identity. And we started lighting up water towers all around. And again, these were the kind of ideas which were starting to form in our heads about the way that we wanted to be. And you know, we wanted to work as a group, but we also wanted to find ways of individuals having identity. We worked with lots of communities in this period. A lot of them, we fell in love with Rossi. We worked with the community there to build their recycling centre. We tried to get them to collect materials in their gardens and bring them around, and we would build the building from them. In the end, I think about 90% of the buildings are the materials are recycled and from the island. But those were the kind of ideas which are now starting to affect what the buildings might look like. These are doors off of people's houses or that were getting knocked down that we were kind of building things from. We always were doing a lot of housing. How did we find identity for individuals in the community? This was an early Alzheimer's centre where people needed to be able to remember objects about their life. So how did we actually build these things into the buildings that they were going to live in, and how did they have some individuality and at the same time have some idea of community and responsibility and individuality? This was crucial to us. So we came to this point that we were, this architecture that we were trying to create, and this is the Titan Crane in Clydebank, and in this case, we've always been fascinated by structures, And in this case, the whole structure, which we repurposed, became an identity for Clydebank itself. So we just had to, we just had to in some way become, and we didn't know about employee ownership at that time. What we wanted to be was a cooperative. That's what we thought. That's what we set out to do. We wanted to be a cooperative. And we embarked on that journey. And we embarked that journey 10 years into practicing. But in our heads, that it was really a matter of principle. It wasn't really a huge business model that we were thinking about. And it's in 2007, of course, we're into Gordon Brown. But of course, in 2007, it happened to be again on the 1st of May, 2007, exactly 10 years on from starting, we all got together and we became employee owners. Now, I'll have to say that the reason that we became employee owners, it was purely camaraderie. We just all wanted to be together and work together. I mean, there's this amazing set of designers all together working with these brilliant buildings. And that was the sole kind of purpose. It was 100% given over. There was no element. The only problem we had was when we actually gave over 100% ownership of the company to everybody that worked there. Was what happens, you know, the problem we had was we were then hit with capital gains tax. We were actually going to lose £300,000 in capital gains tax. So all of a sudden we realized, well, this is a bit trickier than we thought it was going to be. There's no way we can afford to give the taxman £300,000. So we set out trying to get a lawyer. And back in 2007, we could not find a lawyer that did this stuff. We went to the RIS, they put us in touch with their own lawyers. And eventually they put us in touch with a firm called McRoberts, who had this lawyer who seemed to work in the back room, but he dealt with this employee ownership buyout of a bus company. And he was able to then set us up on this course of employee ownership. And it really was that. It really was all for one. That's what we were doing. Now there's 15 of us around about that time. And the way we approached it was, well, who wants to be a trustee? Well, everybody wanted to be a trustee. So we thought, yeah, we'll all be trustees. And there was 15 of us. And for us, that made complete sense. It was democratic. How that then meant that you organize yourselves is a different question altogether. And I will come on to that. But for us, it was completely democratic. We also worked in, and it's interesting to hear some of the talks earlier on, that people could not leave with the shares. We've got carefully worked into our articles of association that the shares are worth a penny. And it's very difficult, although I can understand some of the earlier talks how that can be difficult if, and the word hassle is used. That has never ever been the case here. We all simply work together. And as for architects, I would say by a mile, the biggest thing and the importance of this was owning the intellectual property rights of your designs. That is what everybody really wanted. That's what architects really want. I mean, we changed our name as well because it's not one person or two people or three people. It's everybody contributes to these designs, and everybody should have a share in owning the intellectual property of those designs. It's so important to architects. It's absolutely crucial. It's really more or less the reason we kind of do it. So it's all for one. That was the reason we did it. Of course, though, that all for oneness perhaps then leads to, it's never actually led to any real difficulties. It's just led to us being aware that there will be potential pitfalls in the future. So off we went. Oops. I don't know, I'm gonna get this to work. Oh, here we go. Oh, and of course, in 2007, what happens? 2008, 2009, we are hit with the crash, the economic crash. So almost from heading out on this course of working and designing, we're straight into an economic crash. Really hit the architecture and the construction industry hard. Everybody remember the 2008 bubble bust. But for us, you know, we have heroes and John Brown Shipyard. These are some of our biggest heroes here. And the fact that what they did was they had a work-in. They actually went on strike, and rather than being on strike, what they decided was we're going to work. That's the way we're going to run our ship. And that was so inspirational for it to us. It's Jimmy Reid, obviously, we're looking at there. So this idea of a crash and the fact that we just would, but what's really important to us is we have to keep working. So we actually started employing more people. Everybody else was making redundancies, but we thought this is an opportunity. We're going to start working. We're going to start working hard now. So that's what, because we work hard. We're prolific builders. So we love that statement from Jimmy Reid, the feeling of despair that pervades people who feel they have no real say in shaping their destinies. Now we believe that in the way that the business model works, but we also believe that wholeheartedly in the way that the environment works, in that we speak to people to glean from them what they want their buildings to be like. So off we went on this course. Now we still passionately believe in this, and as an architecture will come from this. This is fundamental to us. So it's fundamental to us that we operate in that way as well as a business. So we start diversifying. This is again our love affair with Rothsay and saving the old Sheriff Court and community buildings there. That was really important. We started working with the old and new. We were diversifying like mad because we decided we were going to work, so there wasn't so much work around. People, we built these palaces for people, these community centres in the peripheries of peripheral states of Glasgow. We spent a lot of time giving them architecture. We worked on special projects. We worked with special people, and this is the Glasgow Women's Library, and we turned that into a special place. We worked with, because of the way we were working, people were attracted to it. People were attracted by these ideas. People understand that you need to speak to people to find out what they would like their buildings to be. And so we ended up building schools, and we ended up building libraries. And there's some fantastic projects as well. I don't want to list them, but there's some amazing designers in our practice. And that's so crucial to them that we work in this kind of a way. But we were asking questions. This of course, is the Empire Cafe. I'd have to mention, Jude, if I mentioned the Empire Cafe. But of course, the questions, things were being questions, and we were looking for answers. And they weren't just business, they weren't just architecture, but they were cultural, and they would become political as well. So there's no point in hiding. That's part of the way that we kind of work. And small things, large things. We believe that we do small things. We will always take on a small project for a community, and we will do large things. We will do very large things, and they kept getting larger, by the way. But there's this idea of a group and an individual. We think it affects the way the buildings, we pride ourselves in thinking that not one of our buildings looks the same. We always approach each project with a fresh piece of paper, that we don't approach clients with preconceptions. And we give each of the architects, as a group, we give each of the architects the opportunity to design things. So we like the idea that all our buildings don't necessarily look the same. There is no house style. But there's that ingenuity and that freedom of expression that everybody's kind of given through this business model and through our general philosophy, which then allows us to flourish. And I put this in, there's a little bit more to go. I don't even know if I've run over my 15 minutes, but this is actually our visions and values. And I love these. And I love these because, well, they're complementary opposites. Now, when we sit down with lawyers and work out our deed of trust and work out down our articles of association, this is what goes in, and it's total ambiguity. I really quite like that. That it's serious, it's playful. There's an individual, there's group, there's large, small, there's profitable, humility, confidence, humility. We actually understand what this means, albeit that it probably doesn't make tremendous legal sense. But it's so important to us, this ambiguity, that you can be something big, but you can also be something small, that you can be an individual working in a group. And I think these ideas are very important to architects. So 2017. Hello, Fiona.
I don't want to rush you too much, but just to let you know, that's us sort of starting to run out of time. I know you don't got too much longer to go though.
I'll run through this bit very quickly. 2017, we're obviously into the next bit. But then all of a sudden, at that point, we built 3,000 affordable homes. We were asked to build another 3,000 affordable homes. And we are now, our company sets itself in perpetuity. We now have 50 people. So of course we have to completely rethink this model that we set up, that everybody is a trust trustee. It simply doesn't work. So we now have elected trustees, and we're in the process of adapting our articles of association to kind of meet that. But we still, these ideas are still with us, and albeit I understand that perhaps the way we set it out in the future, in the past, maybe has made things more awkward for us in the future. But I think it's meant that spirit of camaraderie is through us all, and it's so important. So we're still doing all these things. We're still doing small, still doing large. We're still all for one, and there'll be Boris, and he'll come along, and I'll be a bit old when he comes along. Well, he's here already. I hope he's not hanging around at that point. But in 2018, there we were, awarded the best UK practice for 2018, which came as a shock because I think very rarely does it ever get awarded for anything outside of London. And that's, I suppose, is our kind of story. So thanks very much. If I can stop sharing.
Thank you so much, Chris. That was super interesting. It was really great to get the context of your practice and kind of bring us back to base camp a little bit and see some of the work that you're doing and how it sort of fed into your company ethos. So I don't think you got the wrong end of the stick at all. I'm just going to move on to our final speaker, Hannah McFarlane from Anderson Bell and Christie. She's going to tell us about their recent change. Thanks, Hannah.
So hi, Hannah. I'm a senior architect at Anderson Bell Christie. So I'm going to give you the perspective from behalf of what's like for an employee to go through this. So just a little bit of background. So we're an employee-owned business in Glasgow. There's about 39 of us. So award-winning practice that's community-led and research-driven, really, because it's really at the core of what we do, and we feed all that back into our architecture. So this is our office on Great Western Road. So we were formed as a partnership in 1991, and that was originally out in Paisley and then moved back into Glasgow, and that obviously changed to moving towards the employee ownership and changed to a limited company. Just a little bit about what sort of buildings we do. So it started out predominantly as social housing, and then we diversified into education, community culture, health, refurbishment and conservation, placemaking and housing. So it is quite a wide range of architecture that we do. Okay, so when the two directors, Stephen Lamb and Adam Bell, decided to look at the future of the company, they were really keen to engage the staff, and employee ownership got raised. But I think the thing that was really key to them was involving the staff in the whole process, asking the staff what they wanted, and if they thought it was a good idea. So I think it all started back maybe in 2015. I'm a little bit fuzzy on this because I only actually joined in 2016. So Glenn came to the practice, and I understand he gave a presentation to the whole office, and there was staff workshops where the staff were split into groups and they went away and researched different parts of employee ownership. So there was a group that researched the structure and management of the office. So offices that have flat structures or hierarchical structures. They also carried out a survey of all the staff to say, did you think employee ownership would improve your job? What changes would help? How do you think, the current teams within the office could work better? Like, what could be changed to make the practice better? One team looked at the buyout, so the whole process from changing from partnership into limited company, pros and cons of the different business models, the differences between a trust or hybrid or direct shares, the whole buyout process, like how that would go about, determining the value of the practice and how a buyout would be funded. There was another team that looked into internal finance, so the structure of the trust, how the shares would be distributed, and again, then funding the buyout. And then there was another group that looked at employee-owned companies already and interviewed them and asked them their experience, just so we could understand what other people had been through, what the pros and cons were, so we could help that shape our journey. So that was back in 2015. So Then we went through the process of appointing an advisor to lead us through the process, which was Andrew Harrison. But what the directors decided is they really wanted the staff to be involved in the whole process. So what they decided to do is they decided to create a buyout team that would be formed of staff to act as the buyers on behalf of all the employees. So what they did is they gave the staff, we went to a vote, so what sort of mix did we want the buyout team to be? Did we want it predominantly the management team, the associates, or did we want it a mix from all the different levels in the office? Did we want it predominantly more senior members with a few more junior members? So the staff voted and they decided the buyout team would be one associate, one architect, one part two, and one person from studio support, which would be our like office manager, our receptionist, people like that. So then it went to a vote for who the members of the buyout team would be. So people put their name forward. So for the associate and architects, we had more than one, but for the part two and studio supports, we only had one person from those roles, albeit they were smaller roles. So sometimes you were only picking from a pool of maybe 3 or 4 people, whereas there was maybe a lot more architects within the office. So the part two and studio support person, they were automatically voted into their role, being the only one, and then the architect and associate roles were put to a vote. So I was voted in as the buyout team member who was an architect. So then once the buyout team formed, along with our advisor, Andrew Harrison, and the owners, we set out to agree the terms of the agreement. So things like value, the payment terms, the number of how the employing business would be set up. So some things we put to votes, so we knew exactly what all the staff were thinking. So it was put to a vote how we wanted the shares, whether we wanted them hybrid, a trust, or if we wanted employees to have shares themselves. So overwhelmingly, the staff voted that they wanted a trust and they didn't want individual staff members to have shares, because they wanted it to be all equal and everyone was equal. So that's obviously what we went forward with. There was things like the number of trustees. We made those decisions. The definition of employee owner, so how many hours you'd have to work, how long you'd have to work at ABC, and we obviously went through all the legal documents and agreed all the terms with the owners. So we became employees on May 2019. So obviously it was a bit of a longer process, starting off with our staff workshops in 2015 to 2019. So this was on the day, the 10th of May, when we signed all the documents. So we've got our advisor, Andrew Harrison, there, and Glenn came along as well and was witness for some of the documents. So just looking back over the whole process for us and for being an employee as part of the process, what I think maybe we'd do differently if we could learn from it is we spent a long time on the process, if we think from 2015 2019, and we did have targets for becoming employee owned, which we slipped. So I think right at the start, I think we would have needed maybe a whole timetable set out of when we were going to have meetings and time to commit to those meetings, and when we needed certain deadlines, because I think the sort of day-to-day of the office got in the way a little bit. Busy spells, like, because we wanted the whole buyout team and the owners there, you know, if people were on holiday and things like that, that would delay when we'd have the next meeting. And so I think that would be a good idea at the start. Like, going along, we did have targets, end date targets, but yeah, they slipped a little bit just because I think day-to-day running of the office and the work got in the way a little bit. Another thing, looking back, the buyout team was obviously elected on behalf of the employees, and we communicated back to the staff. I think because it took so long, I think we would make sure, would hopefully if we were to do it again, it wouldn't take as long, but also communicate to staff more. We communicated quite a lot, but the thing we found difficult was a lot of the time the buyout team was subject to confidential information that at that time couldn't be shared with the rest of the staff. So sometimes we found, because we couldn't share as much with them, we maybe tended to share less. So I think I would make an effort to be sharing more information that we were obviously allowed to, and also communicating when nothing was happening, because I think a lot of the time we were aware there was nothing happening, but that could have maybe been communicated a little better to the staff. Forming the buyout team, I think it was a good way to get the staff involved, but I think for me especially, it was maybe, I was really keen and I was really excited to be involved in the whole process. But then I think once we got into the nitty gritty, I started thinking, well, I'm just an architect. I've never run a business before. I don't know, like, the value of the business or the legal terms. Like, we had an advisor, but I do think maybe at the start, if we'd maybe had a little bit more of maybe like a business workshop where the buyout team could have maybe learned from maybe in like other people who'd gone through the same thing, or maybe shared experience, or had that experience at the start. Because I think what happened was we were given a lot of information, and we weren't really sure because we didn't have the experience as acting as buyers. But through the whole process, our advisor, Andrew Harrison, was really good, and our accountant was really good at explaining everything to us. And also we sought some extra sort of business advice. So the buyout team went and had a session with Alistair Gibb as well, which was really useful, just to understand about buying and selling businesses and how a business is valued. So that was really useful. Another thing I think, looking back, is if there's a change that the staff want and the office wants and the owners were looking for and the directors would like to do as you move to employee ownership, I think you don't need to wait until you're employee owned to implement it, because I think our office was really keen on the idea, and they were keen to look at different things that the staff were interested in, such as, core working hours, having a little bit of flexibility with our days, so we're not necessarily 9 to 5:30. And we did start to introduce those things earlier. Communication, we got a lot of communication already in the office, but staff sort of voiced that they would like more, so that started early. And I think that was a good thing, like, because it sort of gradually, everyone there was a little bit of a shift in the culture, because obviously we had a sort of traditional setup where there was directors, and it was a very hierarchical structure, because we have a directors, a management team of associates who each lead a team themselves. So then in the team there'll be an associate, possibly a senior architect, architects, part 2 and part 1. So it was a very sort of traditional structure. So it was good to, when we were all looking forward together to see what we wanted for our employee-owned business, it was good so that people could voice like things they would look for in an employee-owned business, and the management team could start to implement them early. So the benefits for the staff that we found that going to employee ownership is we've had new directors that have been appointed. So that has obviously made, they've been appointed in-house from associates, so there's new associates, so people can see a little bit easier like a career progression. There's maybe opportunities opening up for more junior staff members to move up. There's definitely been increased communication. A lot of the time, a lot of things in the office predominantly were agreed by the management team, and there's and that would be fed back to the staff. And what we found, or what the staff have asked for as well, is just that communication to be increased, so the staff just know a little bit more about what's going on. Staff have been getting involved in working groups, so we've been looking at different policies that the office had, and is there any policies that the staff would like to change, or they would like to to research more about and possibly suggest proposals to the management team and directors. So things like parental leave, maternity leave, that's one that's getting looked at the moment. So it's just sort of feeding in like what do we want this this business to be together. There's been the sharing of financial information, which has been useful, especially in the most recent months, so that the staff are like fully aware of what's going on, so you really feel included and you know how the business is doing. We're doing an annual survey on the office culture, which has been really useful. So it's an anonymous survey and ask questions to try and gauge how staff are feeling about the office. And what the good thing is as well is staff can make suggestions, and that just goes straight back to the management team who review it and feedback to the staff what the actions are from that. And so we've done that 2 years in a row now, so next year will be the 3rd year. But what's been interesting to see is that the results have increased. So the sort of people are enjoying the culture, and the actions have had a positive benefit, which has been really good. The benefits the staff have already seen are one of the tax exempt bonus as well. The core working hours were trialled, and the trial was successful, so now that's been implemented. So there's a lot more flexibility on the working day for the staff, which is the key thing staff are looking for. We now have salary banding, so based on your job description, you are within a particular banding, so everyone in the staff in the office know what band you're in. So there's that transparency. And we've already also made a remuneration committee, which is made up of the employee elected trustees. And what it is that the directors need to go to them to agree changes to salary banding, and also changes to any of the directors' remuneration, just so there's just that extra level of transparency that everyone was quite keen to involve. And that.
Thanks, Hannah. So if we can just get the speakers to all turn their videos back on, please, and their mics on. And Alice, who is in charge of the EAA events group, is going to join us and read out some questions.
Yeah. Hello, everyone. So I'm going to start with a question from Carol McBain. I'm going to ask Glenn to answer this. Could we advise on some ballpark costs to set up an employee ownership trust, and what happens if not all employees want to change to an EO trust?
It's important to note that an employee ownership trust is one element of a transition, and I'm sure the other advisors would say there are financial costs, there's legal costs. The legal costs make up probably 65% of the costs, and there's also employee engagement costs, and probably Val would be best to answer in that regard, but there would be a wide range of costs. So in our feasibility studies, we would say that for a business of turnover $1 million, you would probably at the lower end be something like 15K, and it can go well north. And I'm sure the further south you go, the further north it goes. And the more partners you have, the more expensive it becomes too. But so that's what I see in terms of the costs.
Okay, thanks, Glenn. I had a question for Stephen. You were mentioning that the company will remain to be run by directors during the setup, so in the transfer of shares. And I'm assuming that happens until the full shares are paid out. And I'm wondering that when using company profit to pay for the shares, is this done gradually, kind of year on year, or can it all be held back until the full amount can be paid in one transfer?
Okay, yeah. Well, I think a lot of it will depend on the share purchase agreement struck with the sellers. And then, I mean, just taking a very basic example, that if again, let's just say it's a trust model, the trust is taking over 100% of the shareholding in the from the shareholders, there sometimes will be some form of payment plan. Say, you know, again, just band about rough numbers. Say the value is £5 million, and then they will try to at least set something, you know, £500,000 a year, depend. But then there may be some other provision in the agreement that, you know, will really be dependent on the profits of the company, because the company can only distribute those profits back up to the trust in order to repay the shareholders, provided it's made enough what we call distributable reserves or profits for the year. So then in times of lean years, when the company doesn't make enough money, and that means the trust cannot pay back the shareholders, there'll be some form of a rollover scheme whereby they don't pay it 1 year, but it's going to be rolled over another year. And that'll be the sort of things when you go to the nub of the documentation will all be tried to be agreed. And I think from personal experience, that's quite the norm. You know, if the owners of the business, they know the business going through a bad patch, there will be some in the agreement that will let them tie it over and pay it back later. It's very unlikely the former owners will try to call up the loan that's not been paid.
Okay, thanks very much. And so I wonder, with that sort of agreement in place, and you're also setting out in how the running of the company is going to be transferred. So I was thinking, if it's being gradually paid off, does the director's kind of involvement or autonomy diminish as the kind of shares are gradually transferred?
So it's not uncommon is that if the selling party still retains some shares, or is not being paid all of this for the shares up front, he would retain some form of not control, but some form of involvement. Definitely will be some form of involvement up front. I mean, in the situation Val gave, it's quite common then. At a start, she was still involved as a director, and latterly she was involved as a trustee. So then, yes, there will be some form of involvement involved. And then it's very hard to predict the future for day one we do the employee ownership. But you're right, there will be some form of a diminishing of the role of the former owner. Even if, as Val said, I think some other speakers say that, at one point you're the 100% owner, you're the director, you sold an employee trust, you still remain as a director because that was a deal struck in the documentation, but then you're just a director in the board of directors. You'll still need to report to the trust, who are the majority shareholders. And there's a bit of a cultural change as well, that people who were previously the boss, that even though they're directors, they are technically no longer the boss, and it still is an employee-owned business then, and it is a cultural shift in thinking. And then for that individual, you expect a gradually diminishing of the roles as they are paid off.
Mm-hmm. Okay, great, thank you. I had one from Val. I think this was more of a clarification, maybe, Val, and it's to Stephen as well. She said, am I right in saying that you can pay out profit share at the same percentage of salary for everyone? So say 5% of salary, in which case the higher salary earners receive more. Does that make sense, Stephen?
Yes, Stephen. Repeat that again. Sorry.
Yeah, so she said, am I right in saying that you can pay...
Maybe Val can just say it. Maybe it'll make...
Val, on you go.
Hi, Stephen. Yes, so we paid profit share before we became employee owned, and but when we became employee owned, it's obviously got to be on equal terms. But,
and you're in the trust. You're not that ownership. So basically, separate rules. Yeah. So your trust. Yeah.
Yes, but so in order to ensure the tax-free bonus at 3,600%, we need to make sure that it's on equal terms basis. But that means that we can say set a 5% of salary profit share, but it means that the people who are earning more actually receive more. Is my understanding correct?
Well, it's a quality of treatment. Again, I might have to park this slightly, because this key qualifying condition is for tax reasons. So normally, I'm not trying to park it, but everyone, you would go to an accountant because it directly affects your tax reliefs available to you. So it is one under, I think it's with the relevant Finance Act that will be in there. But the general principle is right, it's that all employees will have to be treated equally. And then I think but you can have differentiated factors depending on their salary or their length of service.
Yeah, that's apparently that's what we can do. Should we pay out a profit share?
Yeah.
So it does overcome if there are concerns from the more senior people. For example, some years we've just said, okay, we'll just have a bonus that's exactly the same for everyone. But then sometimes we think, well, okay, the people who are more senior should maybe get more. But my understanding is that we can give a profit share on the basis of a percentage of salary.
Right, and then I take it then you probably check that with your accountant. So
and the tax guy and the lawyer. Yeah.
Yeah.
So check, and double check.
Yeah.
Okay, great, thank you. So I've got a question for both Chris and Hannah. So Chris, I'll ask you first. Day to day, do you find decision making straightforward? Because from the outside, you imagine if everyone has a say, it could be quite chaotic trying to reach a decision.
At times it can. I suppose it depends what the decisions are actually about. Sorry, I was just going to add something to that previous conversation, that it isn't always money which are the benefits to staff. So we do look at giving benefits across, which might actually to do with time and things like this, which actually rather than just money, which we find a bit easier because architects don't make an awful lot of money. But in terms of like decision making, we've quite a kind of federal approach to decision making. We're split up into a number of groups, a number of teams, a number of specialisms, and we try to give everybody as much executive power as we possibly can. I mean, the whole point for us is actually to empower people. So we empower people as much as, I mean, I'm hoping I don't give away a lot of our ideas to our kind of competitors here. But I mean, for example, we've got 50 employees. We actually empower everybody, and we talk about it. Everybody can go and get a job. Everybody can speak to a client. Everybody can find a way of commissioning work. And so we encourage it. So we encourage people to do that, because if you've got 50 people who are all out looking for projects, rather than perhaps the 2 or 3 people in the golf course, of course you're going to do a lot better. So we actually empower people as much as we possibly can, and let people make their own decisions. And this is always the slight anomaly that we have, is that we try to do that, but at the same time we have to also keep some control. And so how do you perhaps go about that? So we try to kind of police each other in the same way that in designs we let people make their own decisions in terms of designs, but they have to be reviewed. They have to pin their drawings up. They have to see what they look like. They have to all be perfectly sure that it meets the kind of quality criteria that we meet. So, and that perhaps then might bring some of the conflicts that you perhaps talked about. But yes, I think the decision-making kind of process, we empower people as much as we possibly can, but at the same time, we find ways of kind of like checking and making sure that the right decisions are kind of made. So it's a kind of balance of these things. So it's a very difficult question to ask. It almost comes down to one of these kind of visions and values that we talk about, where we've got that ambiguity kind of built in. But of course, with EAA, ISO, all these kind of things, so we have systems that things have to get checked before they go out, and so that it's very important to us that, you know, because it's quite a responsible job an architect, that mistakes aren't made. So yes, a kind of a yes and no answer that, if you like. So we find ways to empower people as much as possible, but at the same time we have systems in place to make sure that the right decisions have been made.
Okay, thanks very much. And Hannah, could you answer the same question?
Yeah, well, I think for us, the structure of the business in itself, in terms of the directors, the management team, and then the separate teams, is still the same. So it's all about, we found, is what sort of decisions the directors want to give away, and want to say that it will be the management team making that decision now, or it would go to a survey of all the staff. So it's I think a lot of it is up to do with the directors and how the company is led, and what sort of decisions they want to open up to the whole office, or they can keep on making as the directors. So I think with us, what's happened is the employees have been given a bit more of a voice. We found that when things are raised, we can track like where the decision-making process a bit more. Like we've set up these working groups, so like if there's something the employees are feeling really passionate about, they can go away and research it and submit a proposal to the management team and the directors, who will then come back to us and say, yep, we can go ahead with that, or we need to trial that first, or no, we need to park this for now because we can't do it for this particular reason. So it's maybe engaged employees a little bit more to be involved in the decision-making process, but in the same instance, it's still the directors and the management team making the big ticket decisions, unless they decide it's something that's maybe not critical to the operation of the business in terms of finances or something like that, and I can open out to the employee base and go to like a vote or something like that.
Okay, that's really interesting. Thank you. So we have a question from Vicky Mitchell. She has asked, do you think that employee ownership businesses are suitable for all businesses? Or is it fair to say from the talks that this is quite dependent on each individual basis? Specifically, Glenn, as you mentioned, you do feasibility studies for businesses looking to change to employee ownership. Is it frequently the case that you find that this is an unsuitable model?
Professional services firms are probably the easiest to transfer. If you have high asset values within a business, it's obviously the financial equation becomes unworkable in most cases. But very often it's the owner's objectives. And I think Chris's business is a case in point. It's very values driven. So I would suggest that the most likely businesses are where owners want to retain a certain set of values, and Val talked about her own set of values and reasons for not wanting to sell the business to the trade buyers. So many businesses are, but ones where there is a very high value, we would struggle to raise the finance. And I'm sure Stephen's, the majority of the trade sales he would be involved in are generally pretty high value, but employee-owned businesses are probably at the lower end of the scale. It's a question of finance, and there's not much finance available for any type of a sale, particularly at these times, in these times.
Yeah, okay, no, that's pretty clear. So I have a question for Val.
Oh, Alice, remember to go back to the second part of Carol's question.
Oh, have I missed that?
So I think the second part of it was, does everyone have to buy in? What happens if some people don't want to?
Oh, right, that's a good point, sorry.
An employee trust is generally set up for the benefit of all employees. If you don't want to accept a bonus, I guess that's entirely up to you. But we don't need the individual consult of every employee to go ahead with an employee ownership trust. And if people didn't like that, they could leave, but there are very few disadvantages of being a beneficiary of an employee trust.
Mm-hmm. Okay, well, that actually leads quite nicely onto what I was about to ask, which is, could you give sort of a general explanation as to what happens to an employee's shares when they leave the company, and is there some sort of like payout for their shares, that sort of thing?
So normally the shares...
Sorry, I was going to direct that to Val.
Sorry.
So we have a naked in, naked out. With the trust, nobody owns direct shares. So I think that would maybe be a question for Stephen. So the idea of the trust is that it is in perpetuity, in fact, and it's all about the beneficiaries who are the collective body of the employees at any one time. So it makes it a lot simpler to administer from that point of view. Nobody has direct shares. So Pete and I still have direct shares, which we probably won't charge for and we'll gift in the future. But yeah, so it's not a complication for us at all. But I think, Stephen, you might be able to answer that question.
Yeah. I don't know. Agreed. I think that's right. That's one of the benefits of having the trust model. And the trust model, none of the employees actually hold shares. They are purely the beneficiaries of the trust. So if they were to leave as an employee, then they simply cease being a beneficiary under trust. Nothing needs to be done to those shares. At all times, the shares are held by the trust, who are the legal and registered owner of the shares. Now, it's slightly different, say, in the sense of the direct model, where the employees do directly hold the shares. And so when they leave as an employee, they still hold the shares as a shareholder. And that's why you would have it in your documentation. They're called leaver provisions in the documentation, primarily shareholders agreement articles association, that will set out the mechanism for essentially for their shares to be taken back. And those documentation also set out the price for the shares to be taken back. It could be fair value, it could be less than fair value, it could be £1, but that will all be set out documentation. I say that documentation also set out a process for taking back their shares as well.
Okay.
Just to add, most employee-owned companies would typically, if someone leaves, those shares would no longer carry any votes, and they would be bought back either by the company or traded at one of the trading days. So that would probably be most common, where an employee-owned business owns a majority of the shares.
I would kind of concur with what everybody said there. I mean, we have our articles of agreement, and it's 1p. The shares are a penny that they're valued at in there. We also had in our original articles of agreement, we're actually rewriting them, that the trust had to own 75% of all the shares at all times, so they always had the majority. But if we were starting again, I think we probably would have the preference that I quite like that term, naked in, naked out. I've not heard that before, but we would probably go, that's, we talk about it, but the kind of 100% trust would be the model. I think that if in my opinion, if we were starting again, we would go for.
Okay. Certainly, that seems to be the way most companies, employee-owned companies, are setting up. Majority trust-owned, 100%.
That's great. I think we'll maybe just tie it up there, given the time. I think that's probably about right. Fiona, do you want to?
Yeah, I think so. That's us up at 8 o'clock now. So thank you everyone for coming along, and a big thank you to all our speakers who've taken the time to put presentation together and then come and share their experience and expertise. Thank you very much.
All right, good night everyone. Thank you.
Thank you.
Good night everyone.